Several months ago when you interviewed me, I think I said I didn't own gold myself because I thought it might go to 3,000. I said I owned it because I was afraid that it was going to go to 9,000. That's not a price projection. But the truth is that gold has, for a very long period of time, taken care of portfolios well when people were concerned about the maintenance of their purchasing power, particularly in reserve currencies like the US dollar. Anybody who isn't concerned about that right now, I think, is operating on questionable premises. So I absolutely positively, it's very difficult for me to understand why somebody wouldn't own gold, in fact. Sixfold, no. But threefold wouldn't surprise me at all. Here's why. My belief is, over the next 10 years, that the United States dollar will probably lose about 75% of its purchasing power. I say that because the on-balance sheet liabilities of the US government are in excess of $30 trillion net. But more importantly, the off-balance sheet liabilities of the US government, Social Security, Medicare, Medicaid, federal pensions, military pensions, exceed, according to the Congressional Budget Office, $100 trillion. So the US federal government is $130 trillion behind the eight ball. That's before state and local governments. To put that into context, gross revenues for the US government are $5 trillion a year. So the debt is what, 26 times gross revenues before any expenditures? We had a circumstance like this before, although not as dramatic, in the decade of the 70s, and the US dollar lost 75% of its purchasing power.
Rick Rule isn't making a prediction, he's issuing a warning. According to him, gold could triple in dollar terms over the next few years, not because it's going up, but because the US dollar is going down by as much as 75%, with over $130 trillion in off and on-balance sheet federal liabilities and real inflation gutting Americans at closer to 7.5% a year. Rule says Washington's only real strategy left is to inflate the debt away, stealth defaulting on every saver and wage earner. That's why he believes gold, and especially silver, are no longer just hedges, they're lifeboats. Because when the market wakes up, when purchasing power vanishes almost overnight, the tiny stack you hold today could end up being the only thing preserving your wealth. Maybe not this week, but maybe as soon as next Monday.
My suspicion is that the way that we deal with all of these entitlement liabilities is that we honor the nominal obligations while we inflate away the net present value. If you take down the purchasing power of the US dollar by 75% without a real move in the gold price, you triple the gold price in dollar terms. And that's precisely what I think is going to happen. By the way, I take no particular pleasure in this. The set of circumstances that causes very strong gold rallies are usually very harmful to the rest of one's life and one's portfolio. And my life is quite good. I would prefer that I didn't have to have this kind of concern. But it's very difficult looking at the arithmetic around on and off balance sheet liabilities in the US and not be concerned about the maintenance of purchasing power of the dollar. I think you could see, as long as you're giving me a reasonable period of time, 5 years or so, I think it could easily go to 9 or 10 or 12. I'm not saying it will, but I'm certainly buying it in anticipation of the deterioration of the purchasing power of the US dollar by really substantial magnitude, 75% decline, like we had in the decade of the 1970s. By the way, that number doesn't come from some cranky old libertarian. That number comes from the Office of Management and Budget. It's a government number, not my number. It's important to remember history, and it's important to remember why history occurred. If you put the arithmetic of US government debt and deficits in the context of history, you have reason to be very, very, very nervous. And in that context, understand that $10,000 gold isn't today's $10,000. It's the $10,000 then. But if you had your choice after 5 years of having $10,000 gold or having had $10,000 drawing 4% interest, clearly you would prefer the former to the latter. If you're a central banker, by the way, buying gold is a very hard thing to do emotionally, because gold calls into question the very premise of central banking. Traditionally, central bankers have preferred to own treasury securities issued by other central banks because it legitimizes central banking. But things changed, as you suggest. The United States decided to weaponize the dollar through the extraterritorial imposition of U.S. will in the SWIFT banking system, and then, of course, by, irrespective of your belief in U.S. foreign policy, by stealing $300 billion worth of Russian gold. I think that in particular China, given the size of the economy and the importance of exports to the Chinese economy, has no choice but to go to gold. They look at the U.S. government as one that they are in a period of increased conflict with, and they look at the predisposition of the U.S. government to weaponize the world's reserve currency. And they also look at the U.S. 10-year Treasury paying 4% in a currency where, from their point of view, the purchasing power is declining by 7.5%. And they say, now, wait a minute, we're giving seigniorage to the U.S. government who doesn't like us, and we're losing 350 basis points of real yield a year. This is a bad deal politically, and it's a lousy deal arithmetically. Against that, you look at any other currency they can trade in. Just how many rubles would the Chinese like, right? The answer is not very many. They're going to go to the BRICS currencies. I mean, none of the underlying currencies behind the BRICS are convertible. Why would the Chinese do that? The truth is now, when China gets rubles, what they do functionally is they turn them into dollars. They have no choice but to hold gold because there isn't another asset class that is simultaneously an asset and a medium of exchange other than gold and the US dollar. And the US dollar has proven itself to be a less reliable store of value and an increasingly politically challenged medium of exchange. Tariffs are taxes. The idea that you put a 25% tariff, as an example, on Canadian goods coming to the US, and that doesn't flow through to the US consumer. I mean, our president shouldn't be smoking whatever he smoked when he decided that tariffs somehow weren't taxes. That's just an insanity and an absurdity. But the rest of what Buffett said, one should be paying attention to, too. Too many people, when they look at the US dollar, are glossing over some basic arithmetic. A lot of people, when they look at the stability of the US dollar, not Buffett, by the way, a lot of people, when they look at the stability of the US dollar, they assume that the inflation rate that impacts them is the CPI. The CPI would tell you that the deterioration of the purchasing power of the US government, of US dollars, 2.6% a year. I challenge you to find any American whose basket of goods and services is only going up by 2.6 a year. Take the period 2020 to 2025. Tell me what happened to grocery bills. Tell me what happened to health care and health insurance. Tell me what happened to rent. Tell me what happened to gasoline. And tell me that the US inflation rate is 2.6% a year. Besides which, the CPI doesn't include tax. The most important component of a household budget in the United States is tax. And the so-called rate of inflation doesn't include tax. I ran an exercise on my own budget, not a slavish one, a back of the envelope exercise, and the basket of goods and services that I consume, and I'm an old rich guy, I don't buy much, shows me that the purchasing power of my savings is deteriorating about 7.5% a year. Now think about the impact of that on the US Treasury. I own a US Treasury. If I did, a 10-year Treasury, I'm getting paid 4.5 in a currency where the purchasing power is declining by 7.5. That means if I loan my money to the US government for 10 years, they solemnly swear after 10 years to give me back 60% of what I gave them. That's a good deal, right? If you believe that gold trades inversely to the confidence associated with savings instruments denominated in the world's reserve currency, obviously one answer is gold. Certainly the answer I've chosen. Over the last 60 years, betting against Buffett has been a really stupid bet. Putting it in perspective, over half of his assets now are cash. Mr. Buffett understands completely that holding cash at 4% generates a negative real yield. So there is a cost to him of having too much cash. He declined to answer publicly anything about the economy. But if you look at the portfolio distribution that Buffett's exhibited over 3 years. He's gone from 20% cash to 52 or 53% cash. Uh, I seriously, I have a serious time believing that Mr. Buffett's analytical faculties are diminished enough that he can't find good companies. He's traditionally been very good at that. I think he's absolutely positively making a market call. If you're Rick Rule, if you don't have Buffett's problem, which is allocating $600 billion, if you're Rick Rule, the U.S. economy is in okay shape. Artificially low interest rates benefit guys like me. I have access to credit, which is subsidized, and I have the knowledge to learn how to use it. But there's a very, very, very thin veneer of people for whom the U.S. economy is working. People who don't have my skill sets, people who don't have access to credit, people who don't have a knowledge of how to use the credit. For those people, things are challenged. There's a wonderful joke in the little town that I live in. Yeah, the economy's generating a lot of jobs. I got to have 3 of them to live. There's some subcurrents under the U.S. economy which are problematic. The economy is working for some. It's not working for most. But the scary thing is, I think, the entitlement liabilities. Most Americans believe that the U.S. debt is $36 trillion or $30 trillion net. They forget the net present value of unfunded liabilities, which exceeds $100 trillion. There's a whole bunch of Americans who believe that Social Security and Medicare and Medicaid and all that is going to be for them. If it is going to be there for them, somehow we need to find $100 trillion, which is to say we need to find 3 times our GDP. If I were Warren Buffett, at least a younger Warren Buffett, I would agree with him. If I had the ability that he has to find great businesses with pricing power that could shield me from inflation because they produce such great products that they could increase their margin at the same way that the deterioration of the US dollar was happening, I wouldn't need to own gold. But I'm not as smart as Warren Buffett. I'll tell you that right now. Absent the ability to generate performance that outstrips the S&P by 400 or 500 basis points a year for 30 years or 40 years, which sadly Rick Rule can't do. For mortals, they have to own gold, but Buffett's not a mortal. Buffett recognized, Coca-Cola at $2 a share. He recognized Columbia Pictures. We'll see. Assuming that Buffett has 5 or 6 years left in him, what his feeling is if his cash hoard grows to 70% or 75% of total funded capital at Berkshire Hathaway. It may be that the circumstance compels even Mr. Buffett to own the pet rock.
So here's the bottom line. Rick Rule is sounding the alarm. Gold and silver aren't just stores of value anymore. They're a warning signal. With America drowning in over $130 trillion of obligations, real inflation at 7.5%, and the dollar set to quietly collapse, your metal holdings could become priceless far sooner than you think. This isn't about a bull market, it's about survival. And if he's right, the world won't be the same when markets open next week. Now that you know what's coming, there's one more thing you need to see. Click on the next video on your screen. It might be the most important update we've released this year.